If GDP is just a number on paper, and the debt mountain swelling to 360% of GDP is a reality, which will crack first? The growth tower or the financial foundation? Look at the glowing skylines of megacities. Below is the wet sand of speculative real estate, local debt, and polished reports. China used to accelerate by double digits. Now 5% suddenly becomes a black spot. Why is it dangerous to stagnate at that level? And why is deflation and ever lower prices more frightening than inflation? To understand today, we must go back to the beginning. After Deng Xiaoping's reforms, the first special economic zones opened up. Shenzhen transformed from a fishing village into a global technology center. Hundreds of millions of people were lifted out of poverty. Chinese production lines penetrated every corner of global life. But behind that meteoric rise lies a system heavily reliant on unlimited growth. Local governments, businesses, and households all assume the upward curve will continue indefinitely, from budget plans, credit flows, to housing price expectations. The machine works like this. Local governments sell land use rights to fund budgets. State-owned enterprises and utilities borrow long-term to build infrastructure. Households pour savings into paper apartments. When the real estate wheel stalls, the domino effect spreads to banks, jobs, consumption, and ultimately, confidence. You can paint the grass green before a visit, but paint can't save a balance sheet. This series of analyses will peel back the layers. Why 5% in China is worrying, why deflation is choking growth, where the hidden debt structure lies, and what really threatens the Chinese century. At the end, you'll find three clear scenarios. Pragmatic view for investors and consumers. China has entered a period of significant slowing growth, from the familiar double-digit level to around 5%. For many economies, 5% is a dream, but in China, it is a sudden break. The reason is that almost the entire local budget system, businesses, and households have been programmed under the assumption of long-term high growth. When the speed slows down, all financial plans struggle, like people who are used to a 10% salary increase every year. Suddenly only 5% home loans, car loans, investment plans are all stretched. By definition, GDP, gross domestic product, is the value of all final goods and services that the economy produces in a year. This number is increasing slowly, while CPI, Consumer Price Index, is a measure of inflation, sometimes showing a deflationary trend, meaning the price level is going down. In a grocery store, it's like having to hang a discount sign all year round because customers are dwindling. Low prices seem fun, but they're a sign of weak demand. Businesses find it hard to raise wages. Workers delay spending, and cash flow slows. The three main engines of the economy are low-cost manufacturing exports, public infrastructure investment, and real estate. These three things are like three legs of a stool. The export leg is under pressure as part of the supply chain shifts to countries with more competitive costs. The public investment leg is hard to pump forever because of reduced marginal efficiency. Necessary roads, bridges, and train stations have been largely built. Rebuilding old ones or moving them to less populated areas only makes maintenance costs pile up. The real estate leg is the most obvious weakness. Transactions are slow, prices are weak, and pre-sale projects, customers pay before construction is completed, are slow to hand over. For a young family, it's a scene of paying interest on an apartment that's still on the drawing board. Local finance is key. A large source of revenue comes from selling land use rights to developers. When the real estate market cools, this money printing machine slows down. To maintain spending, many places rely on LGFVs, local government financing vehicles, to borrow money to continue projects. Imagine a town that wants to upgrade its downtown. The government sets up LGFVs to issue debt, signs contracts to build commercial buildings, and hopes to resell surrounding land to pay off the debt. If people and businesses really come, the plan can be managed. If not, the town is left with a half-baked concrete block and a red-hot balance sheet. The banking system is under pressure from two sides. Real estate companies need to restructure debt. Households are spending less. wary of mortgage loans. Even if large foreign exchange reserves can help stabilize the exchange rate and reassure sentiment, household confidence is the decisive fuel for consumption and retail investment. If people still prioritize saving money over shopping, the domestic growth cycle will find it difficult to rebound strongly. In short, bonjour, the current picture is a large economy with plenty of room, but three legs of the chair have lost stability. Exports are subject to supply chain reallocation, public investment has effectively reached its ceiling, and real estate has turned from an engine to a burden. From here, the question is no longer why is it slowing down, but what risky choices has the system locked itself into? For more than a decade, China's economy has operated like a credit-fueled machine. Land feeds local budgets, public investment keeps growth going, and real estate sucks up household savings. This model only works if asset prices continue to rise and future revenues are large enough to pay off today's debt. When growth cools, the previously engaged gears start to squeal. The key is the local finance mechanism. Provincial and municipal governments collect large budgets from the sale of land use rights. When this source slows down, they set up LGFVs, local government financing vehicles, to borrow more and continue building projects. Imagine a riverside town that wants to upgrade its appearance. LGFV issues bonds, builds plazas, overpasses, and commercial areas with the expectation that new businesses and residents will flock to it. Land prices will rise, and future budgets will compensate. If the expectation is wrong, the town is left with a concrete block with little use and a long-term debt hanging in the balance. In the housing market, the pre-sale model is very common. Buyers sign contracts and pay while the building is still on the drawing board. The developer uses this cash flow to rotate, pay off old debts, and open new projects. Households take out long-term mortgages to catch up on prices. Banks become the conduit, pushing credit into properties. When the market slows down and handovers are delayed, buyers tend to delay repayments. Banks face NPLs, non-performing loans. An unfinished apartment, a young family still paying monthly interest, and a bank having to consider setting aside provisions. That's a very real picture. State-owned enterprises, or SOEs for short, also play a big role. Many SOEs in infrastructure, energy, and railways expanded on the assumption that demand would continue to grow. But ROI, return on investment, declined as easy and efficient projects were completed, leaving behind projects far from residential areas and with low traffic. A new bridge costs not only to build, but also to maintain annually. If traffic is sparse, revenue is not enough to cover expenses, the loss will be returned to the budget or balance sheet of the SOE. Another less tangible risk is distorted information. When growth targets are linked to staff evaluations, all levels have an incentive to beautify the data. Low credit prices and optimistic figures create a false sense of security. Average projects suddenly seem effective on paper. Households lack diverse investment channels. The stock market fluctuates. Peer-to-peer lending models that once flourished were squeezed due to risks, making real estate almost the default warehouse for savings. Cash flow is therefore concentrated in hot places. When actual growth declines, the chain of expectations breaks down in a domino effect. Local budgets have a deficit, having to borrow new to pay old. LGFVs are having difficulty rotating. SOEs are stuck in low-efficiency projects. Banks are more cautious with real estate credit. Households tighten spending due to debt burden and income risks. The obvious image is a peripheral city. Shopping malls are empty, brand new train stations have few trips, apartment buildings are hanging under cranes, and homebuyers are waiting for the handover call that has not come yet. The debt-fueled growth machine is therefore like a car climbing a hill with a steady throttle. Take your foot off the wheel and the momentum is gone and the weight of debt drags the car down. That's why risk doesn't grow because of a single shock, but because of multiple weak links. From there, the historical lessons of economies once reliant on assets and credit show the way out, or deeper into the hole. Looking back at history, Economies that rely too heavily on assets and credit rarely fall into free fall immediately. It is usually a long process: falling asset prices, rising bad debts, banks tightening lending, cautious public spending, and persistently slow growth. Japan in the 1990s and Spain after 2008 are two typical cases, showing that the way out or down depends on how the balance sheet flaws are identified and the debt is dealt with. Japan entered the 1990s after a real estate and stock market boom. When the bubble burst, the banking system was filled with NPLs, non-performing loans. Many banks fell into zombie state, not dead, but not strong enough to pump new credit to the private sector. Prices stagnate or even fall, creating a spiral of negative expectations. Businesses postpone investment, households postpone purchases. The obvious picture is of office buildings with signs for rent for many years and nominal wages almost stagnant. However, Japan has some cushions. Per capita income was high when it entered the recession. The institutional system is transparent, and the safety net is good. Banks are gradually recapitalized. Bad debts are processed through many rounds, albeit slowly. The result is a prolonged period of low growth, but social stability and a maintained quality of life. Spain is another variation of the real estate story. Before 2008, housing construction boomed. Local savings banks, cajas, boosted lending to new urban projects. When the global financial crisis hit, unfinished projects lay in the sun. New urban areas became ghost towns, and unemployment rates rose sharply. The difference is that Spain is in the Eurozone and has been supported by the ECB, European Central Bank, and ESM, European Stability Mechanism. The country set up a bad bank called Sareb to collect and dispose of bad assets, restructure the banking system, and gradually restore confidence. The price was years of fiscal austerity and high unemployment, but the process of identifying losses and cleaning the balance sheet was relatively decisive. The similarities with China are that real estate was once the engine, then became a burden. Local governments and financial institutions are easily trapped in a cycle of borrowing new to pay old. And when house price expectations reverse, the wealth effect drags down consumption. Imagine a new urban belt, modern but sparsely populated roundabouts, squares, train stations, next to a row of unfinished apartments, while home buyers continue to pay interest on unclaimed apartments. But the differences are clear. Japan was already rich before the slowdown, while most Chinese households do not have the same financial cushion. Spain has an external buffer from the ECB and ESM. China has no international lender of last resort, but relies on its own capacity, capital controls, and a state-dominated banking system. This allows for quick and broad intervention, but also increases the risk of zombieization of businesses and banks if losses are not transparently recorded. The lesson is straightforward. Either accept losses, deal with bad debts, recapitalize banks, and discipline public investment like Spain, or accept a Japanization trajectory of prolonged low growth. Each path has its costs, but delaying only increases the penalty interest bill. If China continues to maintain the model of pumping debt to keep pace, the current cracks will widen into gaps. Imagine a newly built apartment building. At first, there are only a few hairline cracks in the wall. The homeowner can hang a picture to cover them. But if the foundation continues to sink, the whole wall will crack over time. In the next 6 to 12 months, the most obvious consequences will still be in real estate. Transactions will be slow, pre-sold projects will be delayed, homebuyers will be hesitant to sign new contracts. Banks will have to increase provisions for bad debts, that is, money to cover loans that are at risk of not being collected. When banks are cautious, less credit flows into the economy, especially to small businesses. In a satellite city, empty shopping malls, cranes stopped midway, young families continue to pay interest on apartments on the blueprint are not uncommon images. Deflation risks taking root. Deflation is when the general price level falls, which sounds good to buyers, but makes it difficult for businesses to raise wages, and workers delay shopping because they think tomorrow will be cheaper. Electronics store owners have to hang up discount signs continuously, but revenue is still thin. At the end of the month, They cut shifts or postpone plans to hire more staff. Rising unemployment among young workers weakens household confidence, and domestic consumption is even harder to rebound. Local finances continue to be under pressure. Revenue from land use rights sales has declined, forcing many places to take on new loans to pay off old loans. Rollover or maturity is taking out new loans to pay off old loans, like rotating a credit card to avoid the cutoff date but not reducing the principal. Local government finance companies, LGFVs, are forced to accept higher interest rates while projects generate slow cash flow. The difference between the interest rate and the benchmark, called the spread, widens and erodes the budget. In the next 3 to 5 years, the biggest risk is misallocation of capital. Misallocation means that money is locked up in low productivity assets, such as empty buildings or low traffic roads, instead of flowing into high productivity industries. This slows productivity growth across the economy, and real incomes do not improve accordingly. As wages grow slowly and the population ages, the economy is likely to fall into the middle income trap, stuck between low-cost and high-tech industries and unable to break out. A particular version of the Japanization scenario is also worth noting. Low growth, prolonged low inflation, and the existence of zombie businesses. Zombie businesses are businesses that do not make enough profit to pay interest on loans from their operations, surviving only by rolling over debt. If their number increases, banks will become more cautious and credit cycles will shrink. External factors also create pressure. Foreign direct investment flows could slow if regulatory risks and profit prospects are less attractive. Some overseas loans for infrastructure programs could become bad debts, reducing the room for domestic policy. Large foreign exchange reserves help manage short-term stress, but are no substitute for structural reform. Taken together, the risk is not an immediate crash, but a slow process. Weak growth, sluggish prices, debt on debt, capital tied up in assets of little use. The time bill will only grow if capital allocation and loss recognition do not change. From here, the regional and global impact is a question for the next part. Would you like me to continue with part 6? A slowdown in an economy the size of China is not just a domestic story. The fluctuations spread through 3 main channels: trading goods, supply chain shifts, and finance and market psychology. The actual consequences will be very different between countries, depending on what they sell to China, what they import from China, and how they welcome investment capital. First, Asian neighbors feel it most clearly through supply chain shifts. As costs and risks in China increase, international business moves some of their assembly to Vietnam, India, and Indonesia. FDI, foreign direct investment, therefore flows more strongly into new industrial zones. An easy example, an electronics company that previously had its entire chain in Guangdong now splits its chain in half, placing the final assembly stage in Bac Ninh or Tamil Nadu to reduce concentration risks. This creates jobs and infrastructure needs in the recipient country, but also requires electricity, ports, and skilled labor to increase in time. Otherwise, benefits are easily broken due to logistics bottlenecks. Second, raw material exporting countries are directly affected by China's construction cycle. When real estate and infrastructure investment slows down, steel demand decreases, causing iron ore and coal to fluctuate. Australia and Brazil are likely to lose revenue. Imagine a mine in Western Australia, ships leaving the port frequently before, now the frequency is slow, selling prices are erratic. Businesses have to postpone expansion plans, and local budgets that depend on resource money have to tighten their belts. On the contrary, some consumer goods exported to China, such as powdered milk and high-end fruit, also face weak demand as households tighten their spending. Third, the financial psychological channel has the power to spread. When macro risks in China increase, global investors often seek safe assets, causing the USD, United States dollar, to strengthen. Currencies in many emerging markets could come under pressure, and new bond issuance rates could rise as investors demand higher risk premiums. A European bond fund could cut its exposure to Asian corporate bonds, pushing up the region's cost of capital even if the company itself does not operate in China. Transport and consumer prices could also shift gears. When export orders from China slow, container rates may fall, but if supply chains are diverted to new locations, the costs of moving house, such as building factories, recruiting and training workers, and certifying qualities may rise. For consumers, this combination creates a paradox. A rice cooker or phone may be cheaper if ordered from a Chinese factory during a deflationary period, but the same product may be more expensive if assembled elsewhere due to startup costs and small scale. Another layer of impact comes from the BRI, Belt and Road Initiative. Infrastructure projects in recipient countries were once expected to boom, but if China's economy slows and credit tightens, projects are likely to be left unfinished or revenue is not met, meaning the host country is left with a white elephant project. Imagine a new railway line, spacious stations, sparse train schedules, insufficient revenue to pay interest. The host government must cover losses or renegotiate debt, and spending space for health and education is reduced. Finally, there is the impact on multinational companies' strategies. The era of just-in-time is giving way to precaution, higher inventories, multi-point suppliers, long-term contracts to lock in risk. A fashion retailer may accept a longer collection life cycle in return for fewer stockouts. This increases fixed costs, but makes the system more resilient to China's shocks. In short, the world will not collapse because China slows, but the growth trajectory and cost structure will change direction. Those who prepare infrastructure, skills, and institutions well will catch the shift. Those who depend on single sources will easily fall behind. From here, the question is, what solutions are needed and which scenario is most realistic to minimize risks and take advantage of opportunities? To escape the inertia of debt-fueled growth, China needs a package of solutions that both repair the foundation and adjust the load. The general spirit is to correctly record losses, transfer capital to productive areas, and rebuild household confidence. In other words, accept short-term pain to avoid long-term pain. The first solution is to make data transparent and thoroughly handle bad debt. Bad debt, abbreviated as NPL, non-performing loan, is an overdue loan that is difficult to recover. It is necessary to publicize the status of NPL by region and by banking group, allowing specialized asset management companies, abbreviated as AMC, Asset Management Company, to purchase bad debt in batches, restructure, and liquidate collateral. Imagine an unfinished apartment building. Instead of letting the cash-strapped developer keep it, the AMC takes over, negotiates with the bank, cuts out the inefficient parts, and prioritizes completing the deliverable parts, thereby saving homebuyers and cleaning up the balance sheet. The second solution is to restructure local government borrowing instruments. Local government financing vehicles, or LGFVs, should be classified according to their cash flow generation capacity. Projects with real revenue should have their terms extended, interest rates reduced, and budget discipline enforced. Those without cash flow should be stopped, their assets transferred to the central government or auctioned off. A province could consolidate fragmented debts into a transparent package, in return for a commitment to cut inefficient investments and open its books to independent audit. The third solution is to adjust the stimulus structure. Instead of pumping into concrete and steel, switch to supporting household consumption. Reduce low-level personal income tax. Subsidize childcare. Expand health insurance to reduce emergency savings. When health and education risks are reduced, people are willing to shop, creating demand for the private sector. This is the way to fill the tank in the right place, instead of pouring into the overflowing secondary tank. The fourth solution is to reform the housing market and household registration. Reasonable property taxes help curb speculation without stifling real demand. Reforming the household registration system, that is the residence registration system that determines access to public services, allows workers to register their household in the city where they work without being forced to buy a house. When there is no need to buy an apartment just to send their children to school, The demand for speculation naturally cools down. The fifth solution is to shift capital to high value-added industries, such as biomedical equipment, industrial software, automation, and financial services. An industrial park that used to make cheap components can gradually shift to circuit design, quality inspection, and cold logistics services. Incentive policies should be conditioned on labor productivity and patents, avoiding unconditional red carpets. From the above solutions, there are three scenarios. Good scenario: data transparency, processing of NPLs through AMCs, LGFV discipline, targeted consumption stimulation. Growth is lower but stable, confidence recovers, real estate shrinks to its proper role. The image is that unfinished projects are handed over completely. Banks return to lending to small businesses. Baseline scenario: half-hearted work. Part of the debt is identified, part is left behind. Low growth persists, deflation lurks, businesses invest cautiously. Satellite cities are still sparsely populated, but no longer completely stopped. Bad scenario: delaying loss recording. Widespread bailouts, widespread zombie businesses. Credit does not flow to productive areas. Households hold cash. Domestic demand is weak. Then the economic car continues to crawl, consumes fuel and overheats, but does not reach the finish line. The choice lies in the courage to record losses and capital discipline. The sooner reform is implemented, the lower the social cost. From here, the conclusion will summarize the message and pose the remaining questions for the reader. The message of the series is clear. The miracle of Deng Xiaoping's reforms has changed the fortunes of hundreds of millions of people. But the model based on real estate, sprawling public investment, and the expectation of unlimited growth has reached its limits. A 5% pace is not bad in itself, but in a system programmed for double digits, it exposes weaknesses. Overlapping debt between central, local, state-owned enterprises and households. The housing market accounts for too large a proportion. Signs of deflation, suffocating consumption. Local finance depends on land sales. Lack of transparency obscures risks. Household confidence declines. The impact spreads to the region through supply chains and commodity prices. Those who prepare good infrastructure, skills, and institutions will catch the shift. Those who depend on single sources will run out of steam. The way out lies in correctly recording losses and redirecting capital flows. Data transparency, thoroughly handling bad debts, disciplining local government borrowing tools, shifting stimulus from concrete to household consumption, reforming the housing market and household registration, prioritizing high value-added industries. The three scenarios mentioned differ only in the level of courage to accept short-term costs in exchange for long-term health. The Chinese dragon is at a crossroads. One branch is a concrete slope that continues to pour money. The other is a gravel road that goes slowly but surely. If you keep wearing empty towers on your back, your wings will become so heavy that they cannot fly. To fly, you have to remove some stones from the saddle, patch the backbone instead of repainting the scales. Which scenario do you think is likely in the next 3 to 5 years? In which industry will benefit or suffer the most? Leave a comment, share your perspective. If you find it useful, please like, share, and subscribe so you don't miss the next analysis.